This is Under the Lens, featuring economic research by Gordon T. Long, editor and publisher of GordonTLong.com. The content of this presentation is strictly the opinion of Gordon T. Long and is based on facts he feels to be accurate as a result of his research at this time. All listeners are advised to independently verify all research for market changes. The following opinions are not in any way a solicitation for business, nor should they be considered investment advice. You should always consult a registered investment advisor before making investment decisions. Now, let's join Gordon for today's show.
Good morning. It is Thursday, April the 18th, 2013. I'm Gord Long at GordonTLong.com. As is normally the case, I have a lot of charts for us to go through this morning, so therefore I will pass over some of them quickly and leave you to examine them further at your leisure. You'll need to open your viewer to full screen viewing or you'll not be able to see some of the detail I'll be discussing. A reminder before we begin, do not trade from any of these slides. They are for educational and discussion purposes only. The purpose of the audio is to discuss key developments in those areas not specifically updated in this month's Global Macro Tipping Points Research Report document. The research document this month focuses on the U.S. economy. Therefore, the slides this morning will focus on our other three report areas: global risk, to be updated next month, the macro situation the following month, and regional developments updated last month. I want to tie them together in a discussion of what I see to be slowing global growth and the limits, actually, of global growth rates. The global growth limits are a direct result of persistent failed monetary, fiscal, and public policy, which critically has not addressed structural issues associated with the rapid globalization that we've been experiencing for close to 20 years now. This is now coming home to roost. I also want to touch on a few of the macroeconomic drivers identified and laid out in each of the monthly report areas that touch on this particular subject. I have shown this chart from The Economist before, though it overstates growth substantially by using the plug political deflator, which is extremely inaccurate and misleading. It nevertheless officially shows that global growth is slowing significantly. On a global level, it has long been considered a global recession if growth slows below 3%. We made excuses during the financial crisis, but now we are below 3% again. But the media no longer mentions this demarcation as the first global recession. This is a consistent pattern with the media, not wanting to dwell or to raise truly negative issues. The recent OECD report makes this graphically quite clear, with only 41% of countries actually in expansion as opposed to 59% in contraction. Don't confuse contraction with slow growth. Contraction is negative growth. The Goldman swirlogram, which I often show here and in the monthly report, is steadily worsening. In fact, it is accelerating towards contraction from within the slowdown quadrant. I won't bore you with a series of macro indicators that are headed lower, but this just released and well-followed Citigroup Surprise Index has just went negative. Considering that the U.S. has been seen as the bright light in the dim global economic recovery, this is getting a lot of attention. Goldman and others have now shifted their expectations for an economic recovery in 2013 out to 2014. Again, getting very little media coverage unless you're one of their client subscribers. While expectations for global GDP growth are now expected to be 3.3% for 2013 against 3.2% for 2012, the IMS has just slashed the previously rosy 3.6 expectation as the global economy stalls. Remembering, this is a political organization, and they understand reducing these numbers any further causes significant backlash. So they're really sending a message when they start to reduce it. The U.S. and Europe has significant cuts to their 2013 GDP, however, on their growth expectation, though, of course, the dip recovers hockey stick-like in 2014. It will perhaps be surprising to learn that Japan had its growth expectation raised the most of all the major advanced and emerging nations. World trade volume growth has also been cut notably, driven by a fall in the previously supposed driver of growth, emerging markets. The IMF's less sanguine forecasts, however, are caveated with hope-driven perspectives such as expectations that debt to GDP will drop for all nations from 2013 to 2018. We were stunned to read that they cite S&P option prices as an indicator of upside potential. It seems even at the IMF that the market is all that matters now. And of course the Japanese printing press. The global growth projection, quite a cone of uncertainty frankly, shows more downside risk than anything and is really the dominant feature in this chart. The IMF report suggests that Japan is actually going to save the recovery. You know, it was only a few months ago, before Abenomics, that the IMF was warning that the Japanese and Spanish debts were unstable. That is code for unpayable and inextinguishable. What changed at the IMF? This is their chart in the top right-hand corner they came out with last fall. Well, what's happened is the economy's not turning around and Japan's printing, so they're the savior. They're also saying austerity doesn't work and have changed to this three-speed economy that the director of the IMF has been pounding the table on recently. Debt in Japan is now 23 times tax revenues. This defines insolvency for anybody who cannot, in actual fact, print their money or print currency. Therefore, technically, countries can't be insolvent. But remember, for sovereigns who cannot be insolvent, insolvency is actually defined by a devaluating currency, and that's what's been happening with the yen. And they want to take it down quite significantly lower. This is going to happen, no question about it, but I don't think they realize how deep and protracted it's actually going to fall. The rest of the world is now betting on that. Doubling the monetary base in 2 years is extremely experimental, especially with these existing debt levels. What they are trying to do is devalue the currency to attempt to become more competitive while holding their market rates flat. This is questionable. If Japan loses control of rates, since leaving the zone of what I'll call insolvency is impossible now, and that's what it's suggesting to me. That's what they clearly are gambling on, that they'll be able to get away with it. I don't think they will. I think for a better period of time. And the extreme volatility we've seen since they actually made their announcement is suggesting this. Markets have changed dramatically since Japan actually came out with their statements and implemented this. And I think they're digesting it, the markets, and it's not digesting it well. Remember, a 1% increase in interest rates would cost 255% of tax revenues. That's insolvency. The Bank of Japan is monetizing at a rate of 75% of the Fed on an economy that's only 1/3 the size of the U.S. How could anybody expect that they'll get their money back by buying BOJs, at least at the present value being placed on them? It's not going to happen. People with that kind of money are not stupid, and they're looking for alternatives. So what we have is unresolved, unaddressed structural issues, and I list them here, from the developed economies being basically insolvent all the way through the list. But the biggest issue is more than just these structural issues, as big as this is. In fact, it's actually systemic. And it's best described simply as the long wave or the Kondratiev cycle. The Kondratiev cycle is an inflationary-deflationary cycle, and I'm sure most are familiar with it, but it's worth revisiting here because it really is at the core, though it is being distorted quite significantly because we've never experienced it with the degree of fiat currency that was available on a global basis to take this distortion, but it's nevertheless actually happening. During spring, inflation is benign. In summer, consumer price inflation increases in line with the monetary expansion, which finances the summer. Price inflation reaches its peak at the end of the summer. During autumn, the rate of increase in inflation falls. It is disinflation. Conversely, in autumn, asset prices, that is stocks, bonds, and real estate, are inflated to extreme levels on the back of a massive expansion of credit. Sound familiar? Speculative excess reaches its peak at the end of the autumn. In winter, prices for stocks, bonds, and real estate and debt plummet. The fall in asset prices and the massive contraction in credit lead to a frightening deflationary depression. That's Fisher's debt deflation. According to Seymour Price, key characteristics of the winter phase are as follows. The economy is firmly overwhelmed by excessive debt and speculation. Prices, employment, output, and investment all fall sharply as the economy goes into depression. Poor management and bad financial decisions which remained undetected during the boom in asset prices are now exposed. Credit markets seize up, and there is widespread bank failures. Debt is reduced, usually through a mixture of bankruptcies and deleveraging. This is what's happening, but because it's being papered over, you're not seeing the bankruptcies. The deleveraging is there, but not as visible as it might be. And the widespread bank failures, again, too big to fail, just won't allow them to happen. And we have no visibility as the bank regulators to what they're allowing to happen on the book. Don't forget, we avoided mark to market and just completely changed those a few years ago to avoid this problem. That hasn't been reversed. We have three major cycles in this process since 1788 and are currently in the late stages of the fourth. The current long wave will likely play out just as it did in the early cycles, that is 1837, 1873, and 1929. Historically, it's not been until excess debt, misallocated capital, and speculative bubbles have been sufficiently purged from the system that a new long wave cycle begins. The transition towards the regime cannot be anything but chaotic. However, this time policymakers can create unlimited amounts of money, as I mentioned earlier, in contrast to these previous long waves. This suggests to me that debt reduction will be targeted through extreme policy activism, which it is, and eventually inflation. Still a ways out, but when it happens, it'll be dramatic and very, very quickly. And it'll be triggered by the fact that the amount of U.S. dollar reserves out in the world are no longer required. They'll start to return. There'll be the United States currency, which will be, in my opinion, the last to fall, will be called into question. And hyperinflation is, as I've talked about many times, is actually a matter of lack of faith in a currency more than it is just the prices going up. Yes, prices go up, but it's a currency problem. And that's what I see on the horizon. And when it happens, it's very quick. It actually doesn't last very long because the currencies have to be readjusted, but the fallout lasts for generations. To offset this, the failing developed economies have resorted to financial repression. I've written extensively about this, but in its simplest form, it is basically the theft of wealth from savers, the retired, the elderly, who've accumulated wealth all their lives, and a transfer of it to the state and its complicit banks who have financed their Ponzi scheme. If you don't believe this is a Ponzi scheme, then please explain to me where the $84 trillion for Social Security and Medicare is. It's not there. This is a Ponzi scheme. Frankly, it makes Bernie Madoff look like a piker. An analyst I respect named Sanjit Das recently wrote that the current economic, political, and social system is predicated on endless economic expansion and related improvements in living standards. Over the last 30 years, however, a significant portion of economic growth and wealth was created and relied on by borrowed money and speculation. Since 2001, borrowing against the rising value of houses contributed to around 50% of recorded economic growth in the United States. And when we were talking about home ownership, HELOCs, home ownership loans during the 2000s and how dramatic they were, nobody talks about that anymore. But it was 50% of the economy, 50% of the economic growth, and it was all borrowed money. Global trade, on the other hand, is built on a financial model. Sellers of goods and services such as China, Japan, and Germany indirectly finance purchases by lending foreign exchange reserves to countries like the U.S. and now deeply troubled Club Med economies such as Southern Europe. This is a form of vendor financing or layaway. It's debt financing of future monies brought forward. Same kinds of issue. Financialization, which is what we have, and I've talked extensively about this with many shows in macroanalytics with Charles Hugh Smith, is about borrowed money and speculation. Debts allow society to borrow from the future. It accelerates consumption, as debt is used to purchase something today against the promise of paying back the borrowing in the future. Spending that would have taken place normally over a period of years is squeezed into a relatively short period because of the availability of cheap money. Businesses then overinvest, misreading demand, assuming that the exaggerated growth will continue indefinitely. They only know linear extensions. That's how they do their planning. Increasing real asset prices and building significant overcapacity. That's what they do. That's what they have done. Debt-driven consumption became the tool of generating economic growth. But this requires ever-increasing levels of debt. In actual fact, it requires exponential increasing levels of debt. How long does that go on? The answer to that is, do trees grow to the sky? When do they fall? You can never really predict when that tree will fall, but you know it's in a state of instability. And something, a butterfly, a small breeze, whatever, and it comes crashing down. That's the state we're in. By 2008, it took $4 to $5 of debt to create $1 of growth in the United States. China now needs $6 to $8 of credit to generate $1 of growth, an increase from around $1 to $2 of credit for every $1 of growth only a decade ago. People don't talk about this. Debt also became a mechanism for hiding disparities in the distribution of wealth in many societies. The democratization of credit allowed lower income groups to borrow and spend, encouraging housing booms in order to deal with the problem of stagnant real incomes. People really forget that this expansion of credit allowed people who never had it before, I'll call it lower income groups, to buy things they could never afford before. That's why we have a 70% consumption economy. How long is that sustainable? It is forgotten that the United States for years was a big concern, even though it was the engine of growth, was because the question was, how long can the consumer can spend at this kind of rate? How long before they became tapped out? Now we've moved to another level. We don't even question it anymore. Now we expect it as a norm. But for at least 15 years, I can remember it was one of the most troubling things to analysts. Not discussed anymore. It's here. We have peak consumption. Economy at 70% consumption, in my mind, is an invalid economy. It's got to be brought back. And most of the developed countries are north of 45 to 55% also. Big problem. That's why we really have peak growth. At minimum, we're going to see a slowing in the rate of growth. That has profound financial implications. The ability to maintain high rates of economic growth through additional debt is now really questionable. The need for governments as well as the private sector to reduce debt simultaneously reduces demand and locks the world into a negative spiral of ever lower growth. Growth was also based on policies that led to the unsustainable degradation of the environment. It was based on the uneconomic, prolific use of mispriced, non-renewable natural resources such as oil and water. There are striking similarities between the problems of the financial system, irreversible environmental damage, and shortage of vital resources such as oil, food, and water. In each area, society borrowed from and pushed problems to the future. Short-term profits were pursued at the expense of risks, which were not evident immediately and that would emerge later and are now emerging. Another common theme in the parallel crisis in finance, environment, and management of the scarce resources is mispricing. In the period leading up to the global financial crisis, risk, especially the ability of individuals and firms to repay borrowing, was underpriced. The true cost of polluting the environment or consuming certain resources has also been underpriced. In all cases, there was significant privatization of gains, while losses were socialized, what I have called regulatory arbitrage. Financiers entered into increasingly destructive transactions, extracting large fees, leaving taxpayers to cover the cost of the economic damage, unpoliced, unregulated, and left to their own demise. In the early 20th century, German economist E.F. Schumacher observed that human beings had begun living off the capital. And I quote him, "Mankind has existed for many thousands of years and has always lived off income. Only in the last 100 years has man forcibly broken into nature's larder and is now emptying it out at breathtaking speed, which increases from year to year." That observation is now just as true about the economic and financial system as it is about the environment that he was referring to. Policymakers may not have the necessary tools to address the deep deep-rooted problems in the current models. Revitalized Keynesian economics may not be able to arrest the long-term declines in growth as governments find themselves unable to finance themselves to maintain demand. It is not clear how, if at all, printing money or financial gains can create real ongoing growth and wealth. It seems to be just assumed that stimulus spending works. Could it be that the medicine we're taking not only doesn't work, but is in fact dangerous to our health? That in fact the medicine we're now taking could in fact kill us? We don't question that. If it's not working, double up. That's just what we did in Japan. It wasn't working after 20 years, so the answer's been to double it up, as if it's the only solution. It is the only political solution. Former German finance minister Peter Steinbrück questioned this approach. To quote him, "When I ask about the origin of the crisis, economists I respect tell me it is the credit finance growth of recent years and decades. Isn't this the same mistake everyone is suddenly making once again? Government intervention can cushion some of the costs of the crisis, but cannot solve the fundamental problems. It is not self-evident that growth can be conjured up by policymakers. If government spending, low interest rates, and policies do not supply unlimited amounts of cash to the financial systems where there are universal economic cures, then Japan's economic problems would have been solved many years ago." The simultaneous end of financial engineer growth, environmental issues, and the scarcity of essential resources threatens the end of an unprecedented period of growth and expansion. But it was an unsustainable world of Ponzi prosperity where the wealth was based on either borrowed from or pushing problems further into the future. The era of continued global economic growth may be ending. Debt-fueled financial engineering growth, environmental issues, and the scarcity of essential resources now threatens the world. Growth and improvements in living standards will slow significantly. Future growth rates may be barely positive, well below even modest 1.8% that we saw between 1987 and 2000. The problem is the economic model itself. As former Fed Chairman Paul Volcker observed on December the 11th, 2009, at the height of the financial crisis, and I quote, "We have another economic problem, which is mixed up in this idea of too much consumption, too much spending relative to our capacity to invest and to export. It's involved with the financial crisis, but in a way it's more difficult than the financial crisis because it reflects the basic structure of the economy." Unquote. A return to economic growth requires a return to real engineering rather than the reliance on financial engineering. It must reverse the trend to a state where the real economy simply supports trading and investment in claims on the underlying resources. I could talk extensively at this point about innovation and the requirement for innovation to the solution, but I'm going to leave that for another day because the answer lies in productivity and innovation. But even that is very much in question when it relates to the degree that's now required. We've waited so long that the magnitude that's needed, I don't think is surmountable. In other words, the headwinds that we've allowed to happen to us and waited too long against the current are going to be too hard for us to roll against. That's my general feeling, but I'll leave that for another day and another discussion. I am discussing this on an ongoing basis in macro analytics with Charles Hugh Smith, so you might want to listen to some of those tapes. In closing, I'd like to take a moment as a reminder, do not trade from any of these slides. They are for educational and discussion purposes only. As negative as these comments are, there has seldom been a better time for investing, in my opinion. However, it requires careful analysis and not following what has traditionally been the true and tried approaches. Do your reading and make sure you have a knowledgeable and well-informed financial advisor. You can't do this on your own. Your choice of financial advisor is absolutely critical. So until we talk again, may 2013 be an outstanding investment year for you. Talk to you again. Thanks for listening.
This has been Gordon T. Long, editor and publisher of GordonTLong.com. New recordings are posted regularly and can be found at GordonTLong.com. New show notifications are available through RSS feed, iTunes, and other social networking venues at GordonTLong.com.